your mid-year outlook 2024, and a lot of market participants kind of wait for this to try and understand what the next 6 months, and it feels like it's just going to be a lot more volatile because of politics. But you're expecting a strong economy in a fragile world. I think that's the title of it. Does it mean that it could shift quite quickly?
No, so the outlook really is intended to recognise that we do think that there is economic strength, you know, trend growth rates supported by strong corporates and strong household balance sheets as well. But the world has many fragilities, and that makes investing feel uncomfortable. And so a lot of the work that we're doing with clients at the moment is to say, look, our investment advice is to be fully invested, but the conversations around making sure your portfolio is resilient, given those fragilities, is incredibly important. And so we do think that equities are going to be the growth driver. As part of our forecast changes, our price target for the S&P for mid-2025 is 5,700. So we've got a very healthy level of upside to the S&P over the next 12 months, and other European equities markets, including Europe as well. But, you know, there are other assets that we should think about as well to reflect the tail risks, so that include recession and higher inflation. And a lot of that, you know, fixed income for recession, but alternative assets for us is a large focus as well.
And in your mid-year outlook, you also pick basically two main themes, which kind of goes to the heart of really everything that we're living day to day in our daily lives, but also in the markets, which is AI and security. So how do you play those thematically?
Yes, absolutely. So these are the two multi-year themes that will affect the next 12 months, but also the longer-term time horizon. When we're thinking about artificial intelligence, whilst it's been something that's been so discussed over the last 6 months or so, we think we're just getting started. And when we think about the percentage of companies using AI today, it's about 5%. And when we think about, you know, the companies in their most recent earnings report who's talking about using AI, that's 50%. So we think we're just at that inflection point. How do you play it? Well, it's through the value chain. Yes, it's large mega cap tech, but it's also thinking through data centers. It's thinking through the power needs. If we think about the new data centers, the AI data centers, they're likely to need 5 to 10 times the amount of power versus a traditional data center. And that obviously has implications for power generation, power transmission, power storage. So we think there's actually quite a large value chain to play. And then there's obviously every sector is going to be impacted by this. And so it brings us back to focusing on quality companies that have the balance sheets to make the investments, to get that first mover advantage, and obviously still distribute to shareholders at the same time.
So expensive companies?
Well, to some extent expensive, and I think this is part of where in our outlook perhaps we're more contrarian, because we actually are quite comfortable with company valuations in the large cap space when we're talking about these firm balance sheets, because when you look at corporate margins in the US, you know, at the highs, and in Europe recovering very nicely, some may say that that's a fragility in itself. We think that's indicative of the way companies have done a fantastic job at actually being very efficient at converting, you know, the equity into cash flow for shareholders. So we feel more comfortable around large cap equity multiples, but we are avoiding unprofitable companies, over-leveraged companies, and so there is that split when we think about risk assets as to the ones we want to own and the ones we don't.